Good morning and a very warm welcome to the 2022 Logistics Confidence Index. And it is a little bit windy, but also a little bit warm. I'm not sure we'll get an Indian summer, but we are launching in reasonable conditions. Thank you very much for joining us this morning. We still think that the online medium for webinars is the best format for what is very much a national survey and a national test of confidence from businesses, from some of the smaller transport logistics firms right through to some of our global corporates in the sector also. And going forward, we'll definitely be repeating the regional dinners that we had this year, and we'll look to get those booked in again in 2023. With so much going on this year, we explored a variety of titles for this year's report, and what a difference a year makes, right? It's not the 2022 we probably hoped or expected, and who knows what's coming off. But yeah, back in January, we thought we were going to be in very different conditions to the difficult ones that we're in at the moment. So we went with changing pace. Volatility tests the confidence of a resilient sector. These key words, I guess, very much represented the feedback from the surveys and the reports that we collected back in from you all. And we also played around with the word optimism, because we know that the logistics sector is very capable at handling diversions and bumps in the road as you see them. And we see the sector with damaged confidence, but very much looking ahead. This is a bumper edition. It's the 10-year anniversary since 2012 when the index launched, and we take a look back at the past 10 years and also a look forward at some of the key themes and trends that are going to come up in the 10 years ahead of us. If you could move on the slide, Ben. Thank you. So my name is James Lean. I am Industry Director at Barclays for Manufacturing, Transport and Logistics. And I am delighted to be joined on the webinar today with co-hosts, Nikki Barrington, one of our Relationship Directors for Transport and Logistics, and also Jason Whitworth, a partner for M&A from BDO, who we co-host and write the report with. Also very much delighted to be joined today with our three speakers and case study businesses. So we have Andrew Howard from PC Howard, Trevor Scott from Simarco, and Martin O'Grady from Clipper. So all those guys are going to be bringing to life what's happening in their businesses, partly looking back, partly looking forward at the key themes yet to come. But we're really looking forward to get into all of that. Jason's going to host a Q&A, which hopefully should be the last 20 minutes of today, and will bring the webinar to close about 10 o'clock. So bear with us. I'm going to give a couple of minutes of introduction to the Confidence Index. Thank you. And then we'll move into the real detail of the report, and we're going to look at a whole variety of themes as part of that. So how's the confidence? This is the big question coming back to all of us, and I don't think with the volatility, uncertainty, complexity and ambiguity out there in the marketplace right now, any of you will be particularly surprised to see such a move from where we were last year to this year. The confidence index has moved from 62.5 down to 50.4. I guess you could say this is a neutral outlook, but I think it's really close to being, to taking a negative position. And of course, this was taken in August, and even more has happened since then. But let's say it's a neutral outlook for a very capable and resilient sector. It's the third lowest score that we've had since records began. The highest was in 2013, when economic conditions were the strongest that we'd seen since 2008, since the financial crisis. And of course, the low was in 2020 again, which you would expect given the amount of volatility and uncertainty there was then. The report today draws out, recognises and celebrates the views of senior leaders of over 100 businesses. So these are C-suite, board and business owners across the sector, again, from maybe a 5 million logistics firm up to 500 billion turnover global logistics firm. So we've really tried to take in the full breadth of views across the sector. The report itself and what Nikki will come on to talk about at the moment are the strategies for tackling key issues and opportunities. Some are predictable, some are unpredictable. There are geopolitical, cross-border, investment, people, collaboration, lots of things to look at. How does your business and how do you respond to change? As every driver of a 44-ton lorry knows, setting the right direction is key, because U-turns are particularly tricky to handle, particularly when you haven't got much room to move. So clear direction, breadth of service, balance sheet strength, but we also understand that as logistics firms, you very much look to your end markets. Those end markets at the moment are also neutral, slightly negative. If you look at the service PMIs and look at the manufacturing PMIs, we're seeing those hovering just underneath 50, which again, I think represents why you're feeling the way that you're feeling across the sector. So Nikki, over to you. Take us through the detail of the report. Thank you.
Thank you very much, James. And moving on to the next slide, thank you, Ben. So my name is Nikki Barrington. As James said, I'm one of the relationship directors at Barclays, having been with the bank for 10 years now, which is incidentally the time at which we've been running this Logistics Confidence Index, now in its 10th anniversary year. James has shared some of the key headlines, and I'll now go into more detail over the next 10 minutes or so to talk you through what you have told us in terms of the outlook for logistics businesses, the challenges ahead, and also some of the strategic opportunities. Before I do that, I wanted to say a big thank you to those of you who've been supporting the index over all these years, and a welcome to those of you who are joining for the first time. In terms of the outlook on the next slide, the confidence index, as James has said, is listed at 50.4, which is the third lowest reading over the last 10 years and down from 62.5 in 2021. It's important to point out that anything over 50 indicates confidence, and therefore we can just about still call it the Logistics Confidence Index, but may need to consider a rebranding for next year should confidence further deteriorate. We asked operators, how did they view business conditions, both looking back over the last 12 months and looking forward to 12 months' time? 61% of you feel trading conditions are more difficult than a year ago, which perhaps could be considered expected, given the cost of living, soaring energy prices, high inflation, talk of recession, plus the train strikes, which is why a number of us will be working from home today. Looking 12 months ahead, we see indications as to why the overall index has fallen this year, with nearly 3/4 of you expecting trading conditions to be much more difficult. Despite this, 60% of operators expect turnover to increase over the next year, which may initially come across as rather bullish, but more understandable when considering revenues are being driven up by higher prices, particularly against the backdrop of soaring heights of ocean freight prices seen over the last 12 months. In terms of the outlook for profitability, less than half of companies surveyed forecasted an increase in profit, 17% lower than last year, which is perhaps not surprising given the negative headlines on the economic situation. But before we get too depressed, let's move on to the next slide and look at CapEx expectations. CapEx remains buoyant, with 81% of firms expecting to make significant capital expenditure. The number of businesses very likely to undertake CapEx has fallen on the last year, which may reflect a natural tailing off of investment in a more challenging market. Given the cost of living, soaring energy prices, you get the picture. Reviewing CapEx trends over the last 10 years, CapEx has actually been trending up, which may reflect the importance of operators investing in their businesses in an increasingly competitive market. Now, we'll move on to talk about some of the biggest challenges ahead. In terms of the challenges, when it comes to identifying the biggest challenges facing the logistics industry, it is no surprise that staff shortages, increased labour costs, and fuel and energy charges are seen as having the biggest impact. Of these, the lack of staff is identified as the highest ranking issue by 78% of participants, with some anxiety that the inflationary environment will drive higher demands for pay. A report from our friends at the Logistics UK confirmed that advertised salaries for HGV drivers increased by an average of 25% in Q1 2022. Maybe I and a few others need to consider a career change, but interestingly, the figure for rising fuel and energy costs is lower than last year at 73%. With some evidence, operators have adapted and learnt to live with higher fuel costs, having priced them into their business planning. With glowing inflationary pressures pushing down consumer volumes, changing levels of demand are also recognised as a key challenge, up from 36% to 66%. Andrew Howard, one of the case study participants who joins us today, references this in his case study and may well touch on this in further detail shortly. Given the cost of living, soaring energy prices, and don't worry, I won't read them all out again, it is perhaps unsurprising that bad debts is still a growing concern, with nearly 40% anticipating this to be a major challenge in the year ahead, compared to just 10% in 2021. Moving on to the skills gap. I mentioned staff shortages on the previous slide, and looking into this in further detail, driver and warehouse shortages remain the primary employment-related challenges, continuing the trend of previous years. We asked logistics businesses to rank in order of importance the areas where the industry skills shortage is having an impact. Interestingly, office staff moved from number 6 up to number 3 in priority, which may well be linked to employees' growing preference for hybrid working and the difficulty for logistics businesses to implement policies fairly across the workforce, given a large proportion of their staff may be on the road. Not so easy to work from home if you're a lorry driver. While concerns about access to temporary and seasonal workers have declined in importance, addressing the widely acknowledged staffing crisis, the logistics industry continues to be a strategic priority for the sector, with businesses having to work hard to attract and retain employees. Beyond improved pay, other examples range from working with young people to looking for new sources of talent, with Clipper in their case study talking about their Fresh Start programme, working with ex-offenders and ex-military personnel and people with disabilities. Diversity and inclusion also plays an important part, noting the upgraded rest stop facilities may go some way to attract more women to the sector. Having recently visited a new truck stop at Dover, probably fair to say it's better than some hotels I've stayed at. Quite a commendable attribute, I'm sure. Now moving on to the ESG agenda. Now we've talked about staff and skills, which form part of the S in ESG. ESG is an abbreviation now commonly used in the corporate world and stands for environment and governance. This year's research clearly demonstrates that pursuing ESG-related objectives is increasingly seen as a business imperative in the sector. Accordingly, just 14% of respondents indicated they won't be investing in ESG, down from 28% 2 years ago. Staff welfare was named as the #1 ESG priority by 56% of respondents, with recognition that employee wellbeing offerings can be an important part in attracting and retaining talent. Turning to the E of the ESG, and don't worry, I won't turn this into a wrap, the environmental concerns, the optimizing of fuel for existing fleets, including the use of hydro-treated vegetable oil referenced in Simarco's case study, together with warehouse initiatives, are ranked as the second and third highest priorities. These can provide a double positive for operators where both environmental benefits and reduced energy costs can be achieved, marking a win-win situation. As for the drivers of ESG activity, 59% indicated it was to achieve top-line growth, just ahead of the 56% who said it was to make a positive environmental impact. The third most popular driver at 55% was compliance, reflecting the importance of governance, the G of the ESG. Now moving on to technology. Technology is playing an increasingly important role within logistics businesses, with the investment in tech to drive operating efficiencies the main driver. Reflecting on the staff shortages already discussed, increasing productivity through automation may, to an extent, help to overcome some of the challenges in the logistics market. The current dynamics of rising operator costs, uncertainty around future staffing levels, and the availability of more affordable tech makes automation a prudent investment for some operators. Competitive advantage and improved service offering are ranked as the second and third drivers for investing in tech. And in terms of supply chain tech, upgrading existing technology came in ahead of sustainability environmental applications, which was actually down on 3% on last year. This highlights a potential conflict between operators wanting to do the right thing while facing increasing growth pressure on margins. And moving on to strategic opportunities, which hopefully is the silver lining amongst the clouds we've presented so far in the report. So for the vast majority of logistics companies, working to increase business through their existing customers was reported by 75% of respondents as a single main source of income, up from 48% over the last 12 months. This may be a result of increased customer loyalty, with the extraordinary challenges associated with the pandemic having strengthened business relationships. This supports the rhetoric of the logistics industry being increasingly considered as a partner rather than just a service provider. A third of respondents also identify extending service offerings, such as improved digital capabilities, outsourced fulfillment, Re-commerce and customers clearance as key to attracting new customers and driving up profits over the next year, noting higher margins can often be associated with these value-add services. 58% of operators listed enhanced cost controls and efficiencies as the next biggest opportunity to drive up profits, which may well be reflective of the higher cost landscape the sector finds itself in. We saw the importance of technology on the previous slide, with 52% of operators marking greater use of tech to drive efficiencies. By comparison, respondents say just 10% of customers that switch providers are driven by price, suggesting the logistics industry is no longer seen as merely a necessary overhead, but now a service-led value proposition. And in terms of the key themes, as mentioned, this year marks the 10th anniversary of the launch of the LCI. And could you move the slides along, please? Thank you. And it's fascinating to reflect on how the logistics industry has fared and evolved over the past decade. As demonstrated in our research over the last 10 years, we've seen how the rise in technology and the e-commerce boom have impacted the sector, together with the persistence of labour shortages, consolidation, and more recently, the growing influence of the ESG agenda. I wanted to pick out just a couple of key themes from this graphic, listing the key industry themes from the past decade, which really does demonstrate how resilient the sector is when considering the number of challenges it has had to overcome. Having successfully battled with Brexit and now COVID-19, we're now in the throes of dealing with the effects of geopolitical instability and domestic economic challenges, including rampant inflation. Ironically, your logistics confidence index at 50.4 sees us almost back to the 52.5 level when we started 10 years ago. And it'll be interesting to see where we get to in another 10 years. Moving forward to key takeaways, get my words out. In the interest of time, I don't propose to run through these. However, I hope this will serve as an encouragement to read our report at full, or alternatively, to cheat, you can just refer to page 33. There are a number of important statistics on this slide, and the one in the middle is on M&A at the centre of this screen, which prompts me to hand over to Jason Whitworth, M&A partner at BDO, who is far better qualified than I am to talk you through the M&A findings of our report. Over to you, Jason.
Thank you, Nikki. I was trying to get, hopefully my camera is going to come on. There we go. That's working. Yeah, thank you very much, Nikki, and morning to everybody. Yeah, if we could just move the slide on, Ben, that's great, M&A. Yeah, so I guess as M&A advisory partner here at BDO, it seems right that I just sort of pick up on the responses in respect of M&A, and it's really interesting that we're seeing effectively another record year in terms of the number of respondents who are saying they are likely to make an acquisition in the next 12 months. I guess this appetite and activity level is something that at BDO here we've been highlighting in our quarterly logistics M&A reports over the last 12 months, and we continue to identify significant domestic and international deal activity across the sector. Really, it's that continued push for consolidation, move to scale, driving efficiencies and new market opportunities, and within the trade industry. Whilst behind that, investors are showing more and more appetite to support trade in that growth appetite. And we highlight a number of drivers behind this in the report, and it'll be interesting when we get on to talk and maybe into the Q&A with the speakers to get their sort of thoughts about their appetite for M&A and what they see as the opportunity behind that. Which gives me the opportunity now to really just move on and introduce the three distinguished guests we are joined by today, who will give us a differing operational view as to what they're currently seeing in the market, providing a flavour as to their perspective on the opportunities and the challenges that they are facing at the moment. In terms of the three guests, we've got Andrew Howard, who's MD at the family-owned warehouse and distribution business PC Howard. Trevor Scott, MD at the worldwide logistics and freight business Simarco, and Martin O'Grady, who is the COO at the retail logistics experts Clipper, which is now a fully confirmed member of the GXO group. After everybody's said a few words, we will then be joined by James and Nikki as well, and there'll be a Q&A session. So there is the opportunity to post some questions. Please do that, and I'll pick up on some of those questions when we get into that to get into that discussion. So it only leaves me to hand over to Andrew in the first instance, and please join Andrew.
Thank you very much, Jason, and good to be joining you all today. As Jason just said, I'm Andrew Howard, Managing Director of PC Howard Limited, a family-owned and professionally managed distribution and warehousing business specialising in the movement of palletised goods. We operate over 100 vehicles and 150 trailers. We specialise in the movement of ambient goods. We're a business with an aspirational turnover of 25 million, moving of the order of 1 million pallets a year. I think what I'd just start with is terms of recent events, and I think one of the things about our industry, and I think everybody agrees with this, we've demonstrated that we're nimble and flexible and have a really good ability to change with changing circumstances, and clearly we need that at the moment. Over recent times, we've seen COVID, we've seen the impact of lockdown, and where lots of people had to work at home, we had to keep the food getting to the shops and keep the country going. So we had to adopt in a different way to COVID conditions, but we kept going. We saw the impact of Brexit. And from our point of view, before Brexit, we had 30 to 40 customers that were selling goods abroad. We've now got less than a handful because of the changes that were introduced and the complexities that small businesses find in trying to overcome the Brexit situation. We were then faced with a driver shortage last year and significant change to not only our cost base, but we had to adapt to how do we plug that massive gap that opened up and was a real threat to not only each of our industries, but obviously UK PLC. And I'll talk a bit more about that in a moment, but we adapted to that. But at the same time, our customers was facing supply chain issues, which I think we tend to probably forget how serious they were at the time. As the UK and indeed the world came out of lockdown, what we found is that there were restrictions because of the impact of factories being able to produce and having the right goods in the right place at the right time, which have just had a knock-on effect. One of the results of that, from our warehousing business point of view, we saw that clearly, is that customers increased stock levels. So to try to fulfill customers' demands and avoid the risk of outages, they increased the level of stocks they were carrying. Warehouse space was at a premium, and effectively that part of the business was extremely busy. But I think where we are now, and as mentioned, that our industry is nimble, flexible. What's quite clear, and it started at the beginning of the year, there is obviously political and economic uncertainty, and as being alluded to, this seems to change by the day. And they used to say a week is a long time in politics, but we've seen significant changes recently, and I think the risk of a downturn as a result of falling confidence and uncertainty from the consumer must have increased. So what we're seeing is effectively those stock levels come down, customers are destocking to release cash, but also to release and reduce risk. We've actually also seen reduced demand. The level of activity from our customers this year compared to last year is actually down, and order books are clearly falling. An interesting benchmark that we have is that we're a member of one of the pallet networks, and it's quite a dominant force within in the UK. And I think it's quite well reported and established that network traffic on the pallet networks are down 8 to 10% on last year, which is a significant fall. And at the moment, when everybody should be stocking up for Christmas, that doesn't appear to be happening. An interesting phrase that I always quote is that actually the wealth of the country is carried on the backs of its lorries, because effectively high 90% of our goods are moved on lorries. We don't have other means of moving goods around. So what affects our industry affects the economy. I think the sort of moving on from the issues, you sort of focus on survival. You focus on where we're going, and from a business point of view, one of the things that we've continued to do and we'll continue to focus on is investment in IT solutions, and that's in solutions with communication with customers and drivers. And I think for a lot of businesses within our sector now, the drivers are not merely driving the vehicles and delivering the goods, but actually they're capturing data on a real-time basis, which is then fed through to the customer and streamlining our operations. So the drivers, despite driver shortage, is more critical to us, and having trained drivers, having working conditions that are appropriate to the qualification and quality of the drivers is critical, and helping them achieve work-life balance, I think has helped us overcome the significant impact of the driver shortage that we saw last year. I think the report mentioned about service, and I would agree, because if customers are under pressure, they want absolute, they're not talking about you getting it right 98% of the time or 99% of the time. They want it right 100% of the time, because they don't want their orders endangered. So service is the I think the key mantra, which then does feed through to getting new customers, and continuing, despite conditions, being able to drive the business, and increasing, obviously from the business point of view, our flexibility. I suppose the other point I'd bring at the moment from a business point of view is, with the risks that we now see out there, being able to manage the business and adapt it to changing levels of activity, but also managing cash, I think now becomes the focus for all of us as we move forward to 2023. That's all I've got to really say, and I think hopefully that gives a good resume of I suppose our perception of where our industry is, where we've come from, and actually where we're going to.
Thank you very much, Andrew. I won't put my camera on, but Trevor, can I pass over to you?
Thank you very much, Jason. Thank you, Andrew. Yeah, similar to Andrew, I'll just give you a bit of an overview of the business, and then a kind of a run through what we see as a business and what we see the future shaping up to be like. As a company, we're 25 years old this year. We're independently owned. Our turnover will be approximately 90 million this year, with 370 employees. We have seen quite good growth over the last sort of 5 years. A lot of that has been through organic, but also through acquisitions, which has been part of our strategy. We have around 25,000 pallets across our two main depots, which is in Essex and Stoke. But we also have a lot of strategic offices around the country, so Bristol, Gloucester, Bedford, Bury, Heathrow. Our main core part of our business is European groupage, full loads and part loads, which represents around 70% of our business. So, you know, we was at the eye of the storm, as they say, in terms of Brexit. And in terms of who we work for, we have a lot of partner network in Europe, but also we work for a lot of global brands, but also SMEs. So we have a scale of business. When I got asked to speak on this, you know, what is confidence? I think we all know in our professional and personal life that confidence waxes and wanes. And with COVID and Brexit, depends what happens. You know, last week, what happened in the news, again, confidence levels would have gone down. But for me, you know, running the business, it's about short-term and long-term objectives. And as a business, that's what we try and do. We have a plan, we focus on it. Absolutely, there's going to be issues along the way. We will have to change that plan, but ultimately, you know, we stick to them long-term objectives of what we want to achieve. And just having a little run around our business. So in terms of European exports, we have seen since post-Brexit, they are 15% down. And I think that tracks similar to what the UK government figures are being published. However, we do have some regular shippers. You know, we do have a strong manufacturing base. You know, will the exchange rate drive them exports up? You know, we don't know at this moment in time. It depends on how long they stay at the level they are. But, you know, exchange rate depression is obviously a benefit for exporters. But interestingly, the imports for our business have increased by 25%. And I think a lot of that is to do with importers re-engineering their supply chain because of the customs complexities and Brexit. So if you look in the past, what they might have done is you know, free flowing across the borders and just delivered directly. A lot of them can't do that now. And we invested heavily in HMRC approved warehouses ready for Brexit, which is an extension of the border. So we kind of solve that problem for the customer. We are seeing, you know, positive. We are seeing more inquiries from overseas companies. So I think they're starting to understand what does Brexit mean for them. And when I say overseas, I particularly mean EU companies. So they kind of understand what that cost base is. They understand how to move the goods freely. And we are having quite a lot of discussions around, you know, bulk movements from the EU, warehousing in the UK. And also they are looking at positively opening up sales offices and commercial opportunities within the UK. So I see that as a positive. And also demand for EU warehousing has gone down. I think a lot of us saw that prior to Brexit and after, you know, everyone wanted a warehouse in the EU to solve their problems. But we know there are ways around that. So, for example, having a bonded warehouse, re-exporting under bond, different regimes. So we're not seeing much demand for that. And as I said, conversely, we're seeing more demand from the EU. And as I touched on, we have a lot of manufacturing customers. So, you know, what's the outlook for them? Well, actually, you know, the outlook is fairly good when we talk to our customers. But they have the challenges of labour and energy costs. So we have demand for the products going into the EU. But the issue is the lead times are increasing due to shifts being shortened. So, for example, you know, a traditional 6 till 6 shift is now an 8 till 4. And that is being driven across all our manufacturing sector because of labour shortage and also energy costs. What we also saw is quite a few of our customers, and Andrew touched on this as well, about stocking up. So they actually went the other way through the summer months when energy costs were lower and actually bulk produced and holding it in storage and then calling it off through the winter. So there's different models that people are adapting. When we look at ocean imports, again, this is linked to stock. So at the peak, $20,000 for a container from the Far East. Them container rates this week are now 80% lower. And that is purely because of the demand is not there anymore. People have overstocked in the UK. But also, you know, with the exchange rate, even if people want to bring it in, they will be affected still because obviously the US dollar to GBP. But we also are seeing sourcing strategies change quite a bit as well. So we are seeing a lot of companies moving away from China. They are looking into India, looking at Turkey, and potentially the EU as well. So yeah, we are seeing a sort of move to nearshoring. And what's Simarco's position? Well, as a business, we continue, again, what Andrew touched on. We the mantra of our business is to be agile and flexible. This forms part of the company culture. It allows us to make quick decisions for our customers, our suppliers, and our staff, and it allows us to convert opportunities quicker. As a business, we're debt-free. We have a strong balance sheet, and that allows a positive attitude to a level of risk. And I do believe you need a level of risk in this industry. We are freight all kinds, and what that means is we move everything and anything. We don't have any sector that's more than 5%, and we know in previous recessions and actually through COVID, there's always popular products. So that allows us to freely move across the different sectors where the demand is, to allow the freight to keep moving and obviously, you know, keep them numbers coming in. And we're focused really heavily on training and retaining staff, whether that's drivers, warehouse. We've invested in management courses over the past 18 months, and also in our whole HR offering in terms of learning platforms. We've just formed recently an employment and sustainability forums, and that for us has been really positive because it's chaired by the staff, no senior management, and it's self-governed, and they have a budget and they are coming up with ideas for the business. So in summary, cautious approach by our customers. They are looking at growth, but expectations are obviously much lower. I think there is resilience with a positive outlook. And what are they looking for? They're looking for reliable and quality logistics providers. They want stability on costs for next year. That seems to be the message. I think they accept that there will be cost increase coming again, but they want stability and they want to budget for it. And as we know, high levels of service will always ensure, as a provider, you're the go-to person as the market contracts. So yeah, that's kind of a bit of a run around the business. So thank you very much.
Great. Okay. Well, I'll hand over to Martin now, just to sort of say a few words. Martin.
Thank you. Thanks, Jason. Morning, everyone. So when I agreed to join, I think I was just in the auspices of being with Clipper, but Clipper is now part of the GXO group. So we're literally the world's largest pure play logistics provider now. Clipper floated in 2014. So in our old guys, we have 55 sites, 600 million pounds of revenue, 10,000 people. That's who we are now that we are part of GXO. What do we do? Well, we are retail logistics specialists, e-fulfillment, pre-retail, returns management. We have a branded returns management capability called Boomerang. We offer value-added services and high-value logistics who operate bonded warehouses for tobacco products and alcohol. And we have a carrier service called ClickLink, which is a JV with John Lewis, which is not many people know that, but we are one of the largest carriers. We've got something like 40 brands that enjoy a high street everyday service 7 days a week from us, and our customers are people like River Island, Marks and Spencer's, Superdry, ASOS, Pretty Little Thing, Inditex. We have quite a wide range, pointed a lot to apparel. And I suppose if I just say that's who we are, that's what we are about. The challenges that our customers are facing and that we've faced with them is, which I think has been mentioned anyway by Trevor and Anthony, is inbound supply is lumpy, it's expensive, and we've got product coming in on behalf of customers now that literally misses the season and will go into storage, and it's expensive and it'll burn a lot of the margin, and then it will come again. So actually one of the things we're experiencing now is a short-term demand for space as a consequence of it. But that's one big issue as a consequence of some of the issues upstream supply chain wise, and some of the global events, of course, contributing to it. Again, customers are experiencing cost inflation, whether that's the cost of goods that they're sourcing. Trevor's point about the cost of a box coming through, a lot of our customers experience that pain. They've got the cost of energy, fuel, whether that's buildings or the vehicles moving product around, and then staff. Attracting and retaining staff is a challenge everybody is battling with, and we are working really hard to be an employer of choice. That's what we are trying to be, which is to find out what does an employee want, what would make it work for them, if that's flexible shift patterns. And if I tell you, normally when you run big warehouses of scale like we would run, we might have maybe a dozen shift patterns that are full-time, part-time, and across 24/7. But if I was to tell you that we are nearing 200 patterns in some of our big warehouses where it's competitive for people to say, actually, we're getting down to what would work for you, because it would work for our customer service levels and it works for you, and we keep you serving the business with the knowledge that you've got with you, the product expertise that you've got, it's actually worth doing. And the problems that creates, we're prepared to overcome. And if that's involving in investing in technology to make payroll function, we'll do that. We're really proud of Fresh Start. Fresh Start is an initiative that we've been working with Tempus Nova, where people who are offenders coming out of prison in certain categories, that we are really happy to give them a new start in life. And we've had real success at it. We're beyond 1,000 people now who are in our company that have come through the Fresh Start route. One of the other things that we're experiencing, which I think is inevitable, is retailers are finding it very, very difficult to forecast. It's difficult. Nobody really knows what the tone will be for peak this year, what tone to use even, and what to expect with all that's going on in the world. And that with the World Cup coming on Black Friday just adds to the fun. And then the sort of the theory then for us is, how do we maintain service and optimize cost? And that comes down really to our customers' appetite for productivity. So can we invest in technology to drive up productivity? Because a lot of customers will say that they are already mechanized. Most people have got mechanization in the warehouses. The next stop along that route is automation. And then the next route along that is robotization. But what we're finding is, it used to be 5 years ago that customers would want to automate an environment or deploy robots because it had a return on investment. It was done for the cost to serve. Actually, it's getting now where it's about security of supply. Can we deliver peak? Can we get enough people? Can we hold them? Can we train them well enough? Can we reduce churn and get a high level of compliance? It's a real challenge, and it's ongoing. So actually the agenda isn't really about a return on investments, it's about a security of supply. And the other thing that we're noticing is the wholesale channel is dying as a consequence of marketplaces. So it used to be a lot of our branded customers would sell product through in bulk through the wholesale channel, take a lower margin and move bulk product through and transfer the title to their wholesale partner. And actually what's happening now is the marketplaces that are in vogue and plentiful are the new wholesale channel. And that brings with it opportunities for us, because sometimes the marketplace will want to provide that fulfillment service, but often we are able to provide that fulfillment service too, which widens the scope of our offer. So really, that was all I was wanting to offer up to the panel today. So thank you.
Thank you very much, Martin. So at this point, can I ask everyone, all the speakers, to just turn their cameras on so we can sort of deal with the Q&A section. I guess just to ease us into the sort of questions, the the challenges are all sort of very visible, I guess, in terms of the market. It'd just be interesting to sort of hear a bit on the positive from each of you, really, as to, you know, what do you see as the sort of biggest opportunity? You know, do you see a real opportunity at this current point in the market, and where do you see that biggest opportunity for your business at the moment in terms of achieving growth, which the government are very keen to sort of push for? And I'll start with you, Trevor, as a starting point, if that's okay.
Yeah, no problem, Jason. Positive and negative, I suppose, depends which way you look at it. I mean, I think there's going to be a continued consolidation of the market, and I think if you have got an appetite for acquisitions as a business, you know, if you've got a strong balance sheet, then for me that is where the growth will come. Because if you just keep standing still with your business, you know, as Martin explained, you know, demand is going down. Demand is going down across all areas. So, you know, for me, it's going to be acquisition. There are some absolute quality businesses out there that have been well run for many years, but they may not have the appetite to carry on to invest because costs are going up. They may have taken the business to the level that they've taken it to. So for me, yeah, acquisitions definitely is on the agenda for us in terms of growth.
Okay. Andrew, how do you see it sort of from your side?
From our point of view, we will continue to focus on organic growth rather than acquisition. And I think the key driver for, as I see it, is down to service. And to achieve that, it's about continuing to invest in IT systems, trying to drive the IT as far as we can. But also about driver and staff training, and I think those are those ingredients that help the service, help the quality, build the reputation, and hopefully attract, from my point of view, new customers through organic growth.
Okay, thanks, Andrew. Martin?
Yeah, I think we are also positive about growth. Obviously, with GXO bringing the power to us, we'll have more services to offer our existing customers, as well as being able to offer some of Clipper's services into the wider GXO. The big opportunity for us is customers wanting to get off their fixed cost base. So our multi-user environments are very popular right now. It's a higher margin business for us to run closed book than open book, and the majority of our current revenues are open book. So actually customers coming to us to say, you know, we've got X amount of years left on this lease, they're prepared to give it up, they can move across and take a variable cost base. That's where I think our opportunities lie. And then the bit that's interesting now the GXO are here, for us is our access to technology and automation, and the advances that they've got in that area. It means that it won't be long before we have an automated multi-user environment, which in itself is sort of a move on from the old-fashioned multi-user shed. No doubt we'll invest in some Meccano, and we'll instead of offering pallet spaces, we'll be offering capacity that it's magnificent when you think about it, because you know what the machine can perform at, you know what it costs for it to perform at, and therefore you can sell that capacity to customers, and they've got real confidence it's going to happen. All it needs, in inverted commas, and I'm smiling, is a serious technology layer that sits outside of that automation that can take multiple feeds. And then, because if you were all customers now, you'd say, well, how would my priority sit next to another's priority? So we've got to find the technologies that will answer those questions, that says mathematically and algorithmically, here's what the answer will be. And I think that's a really exciting future for us. And with GXO in our corner, we'll have the resources to do it.
Yeah, thanks, Martin. And you all sort of raised service and quality of service in what you were saying earlier, and thanks. Rob sort of fired in a question. You know, do you think, you know, over how we've managed our way through the supply chain challenges, etc., that, you know, customers value and appreciate that the importance of the supply chain post-COVID, you know, post-Brexit? Do you think they're and it'll bring me on to a follow-up question about pricing and getting revenue increase. Are they, is there an acceptance that they recognise they need to pay for that quality service that allows you to sort of bring that through in pricing? And I guess, Martin, if you want to sort of kick off on that.
So I think the answer to that is customers want, to Andrew's point, service. Absolutely, that's the premise of all our meetings. I think when it comes to the cost of delivering that service, when forecasts are so erratic, so I think the problems our customers have got now is they don't know. For example, when it comes to planning peak, I think England play on Black Friday and the game finishes about 2 hours before most econ cut-offs. Now, if we were all here now saying literally, how many orders do you think might come in then at the final whistle? And are we holding the service level for it? Are our retailers saying, we want that service? If those orders, that kind of stuff, it's difficult. So I think our customers are prepared to pay for a good service. That bit, Jason, is right. I think that where challenges lie is in capacity, squeezing capacity out. So when it comes to what will the future hold in terms of, for me, in terms of trends, banked hours, flexible working, maybe working for 3 employers where you stitch your working week together because you're topping up automation solutions. I think we're about 5 or 7 years away from an employee walking down the road, working 8 hours for one retailer, and then tomorrow working 5 hours for another. So I think it's a long answer to a fairly short question, actually. So I think customers want service. I think they want it at an optimal cost. I think the problem with cost and service comes forecasts, and it's as everybody knows, it's mythology. Getting forecasts right, it's really difficult. Everybody battles with it.
Yeah, good, thank you. Andrew?
From my point of view, I think it does come back to service, and that is our driver. And I think new customers coming in, it's an easy sell, to be honest, because effectively people change, especially at the moment, and it's normally to do with service at the moment rather than cost. So I've just gained a reasonable size account, and we were fairly open with them about obviously pricing, but they were open about their pricing, about the increase it would be, but they were happy with that to get the service. And that's going to be interesting because I've got my first review meeting with them tomorrow, to be honest. But that, I think new customers coming on board, always a bit more of a challenge is when customers come on board and they see a good thing, is in a year's time trying to say, right, we need this increase, because they then accept the new service level as taken. So there's always a bit of a challenge then to say, actually, we're delivering this for you. We need a premium for delivering this. And it's just making sure that they see the reason for that.
Yeah. Is that, have you got similar sentiment, Trevor? Or?
Yeah, similar. I do think it's reaching its peak. For us as a business, we're kind of going into next year with increases kind of tiptoeing, shall we say, into it. What we're actually discussing internally is how can we be more efficient. So I think it's a two-way street now as you start moving forward. And one of the other areas that, as an industry, we've been guilty of in the past, and it happens in all industries, but I call it the race to the bottom. So if you think about the price, what's happened with all the PPE in warehouses, the overstocking, etc., warehouses going up like you wouldn't believe it across the country. Suddenly, when that capacity is far greater than the demand, there's suddenly that race to the bottom, and everyone starts cutting cost again to try and fill their warehouses, and we go back the other way. So it can swing very quickly in this industry, and I think the warehouse capacity is something that, from a cost point of view, people have to really be conscious of.
Yeah, and I thought, Trevor, Martin raised a point about sort of moving to more sort of flexible service closed book. Have you seen a sort of shift in how your pricing work and how you're being more, maybe more closed book, or are you seeing that shift to
I mean, our business model has been mainly variable anyway. You know, strategically, we haven't really kind of gone down the e-com route. We're sort of more wholesale, bulk, maybe sort of at that carton pick pallet level. And that's for us as a business is a strategic decision purely because most of our warehouses, you know, are cross stock from a European point of view. So yeah, so we've always been very on a variable model.
Yeah. Okay. We all talked about sort of, if you like, UK stock, you know, in terms of stock, UK PLC being full of stock across the board, that warehousing position. Do you see that starting to change? Your pricing of warehousing sort of really peaked when you talk to some of the property agents, you know, and one of the things, you know, James and I picked up on all the dinners that we were talking about was this sort of low availability of warehousing. I think sort of available space was something below 2% or something, according to the property agents at the time. Are you, with that destocking that you've all referenced to a degree, are you starting to see that open up, or do you still see that as sort of 6-12 months, even longer away? And Andrew, I'll sort of start with you. I don't know what your sense is of that sort of stocking side of things.
I think it's a mixed picture, to be honest, at the moment. It isn't totally clear. I've got customers that are clearly destocking, and actually they've made it clear that is their driver. I was with another customer yesterday though, who is actually trying to build its stock levels up, and precisely because they've had issues with a lack of stock, and therefore our vehicles running at below capacity because product isn't available. They're trying to build their stocks, but as I say, I've got other customers that are trying to go completely the other way, and I think it's dangerous for them to go too far the other way, because effectively they then threaten the lead times, and they threaten the service to the customer simply because they haven't got the stock available in time. So I think there's a balance at the moment, and people haven't found it.
Yeah. And I guess, Martin, you're at the forefront of it. Fast fashion, I guess, is sort of the heart of what you're involved with. You know that sort of build-up of stock, that management of returns, you know, is such a complex area. You know, is that just continuing to build? I mean, how are they going to flow through some of that stock they've built? Because I guess with fast fashion, if it's not sold within a very short period, it becomes out of fashion very quickly as well.
Yeah, and I think Trevor was making a point earlier on about long supply chains. You know, sourcing product, as a lot of fast fashion is in Asia, takes time to get over. And if you've bought a bad line, you're stuck with a bad line. If you've bought a good line and it sells well, you've got a long replenishment cycle. So the nearshoring that everybody has been talking about recently over summer with our customers, or maybe even Easter, was into Turkey, and taking road trains out of Turkey to get them into the UK. It still doesn't solve the problem of bad buys though, and it doesn't solve the problem of a competitor having a better offer than you, because these guys have got you know, hundreds of thousands of SKUs. You know, that some of these warehouses are libraries, where we'll have one SKU of maybe you know, one particular color, one particular size, or combinations of. So returns is still the problem it always was, which is expensive, and you can lose a customer doing it badly, and you can wow a customer doing it well. And that's where a lot of, actually, when we're talking about where one might invest, investing in returns now, because it costs a lot more to handle, as everyone knows, a returned product than it does a forward sold product. But that's where a lot of investment is. When it comes to lease costs, we are finding now that landlords are not as bullish as they were, say, at the turn of the year. We've had prices for buildings that were coming out of the ground in the northwest. The landlord was arms folded with me in Q1 this year. There's no movement, and if I offered a meeting this afternoon, I'd get one at another number. So your land prices are falling, and therefore the value of these assets are falling. But that's to be welcome, by the way. Yeah. So I think, sorry, that's a long answer as well.
No, that's fine. I'm just conscious of time, so I'll just pick up on one other subject, and I might start with you, James, just to see what you talked a lot about. That, you know, the appetite for investment is still coming across as strong, particularly the sort of technology. And Martin talked about, you know, sort of automation, robotics, and so on. Not only as a sort of return thing, but actually as a security of supply piece, you know, and managing labour challenges, etc. I mean, what's your sense from the banks? Is there a sort of push? Is there a lot of chatter in the bank? Are businesses looking for support for investments? What's your sentiment as you're sort of out in the marketplace?
Yeah, thank you. Just checking I was paying attention, Jason. Don't worry, I'm all here.
Yeah.
I think so. What we sense, I mean, robotics, automation is key in manufacturing and warehousing. Everyone is looking at that, and I think you know, everyone is dealing with their seasonality. So in food and drink, it's Christmas. Other parts of retail, quite often Christmas again. And you're either bringing in temporary workforce, which may or may not be available at that key trading point for you. And so technology, I think, is enabling you to create a base which then frees up your core workforce to help you when you've got peak demands. So yes, absolutely, customers across the base are investing in robotics and tech and autonomous forklifts, even at the basic levels. And of course, in the last mile delivery aspect, which we haven't really touched on today, you know, we see these little vehicles out and about driving around the paths, delivering food on local housing estates, which I think is a wonderful step forward. And all of those can be financed in a variety of ways. But yes, definitely a key theme with lots of clients investing.
Well, thanks, James. Yeah, always frustrating this, because I feel like I'm just getting warmed up, and yet time is against us. So I do need to. I probably do need to draw things to a close at this point. So thank you very much, everyone, for joining in on the Q&A. So I'll just, I really just, I mean, if you want to turn your cameras off, you can, but I'll just sort of close really by saying that. Look, the report is launched today. We'll be sending a copy to everybody who has joined us on the call. I do hope you sort of take the time to have a deeper dive into the findings. You know, we obviously feel it's very interesting, you know, and there's some really sort of interesting insights in there in terms of views. I think as was mentioned earlier, the reality of the market at the moment, we almost sort of seem to be, with mini budgets and everything else, changing dynamics, moving on a day-to-day basis at the moment. And I've no doubt there'll be a few more challenges that'll come out of some of that going forward. So it only leaves me, on behalf of Barclays, BDO and myself, to thank everybody, our speakers, Martin, Andrew, Trevor, to thank Analytica, who sort of helped us put together, did a heck of a lot of work putting together the report. In particular, I'd like to thank all the respondents and contributors to the survey, without whom we wouldn't have had anything to share with you today. So thank you very much. It's your insights that and your your evidence and information that sort of gives us the feedback that we can provide in the report. And then thank you everybody for joining this morning. I think personally, I just reflect on how, you know, it's interesting how, when you look at the 10-year sort of position on the report, how the industry has continually adapted and developed to both create value and meet the great many challenges that the markets have thrown at us over the last 10 years. The skills and the resilience that this industry, has built and shown and developed is no doubt going to be paramount as we sort of look to maximise the opportunities and deal with the challenges as we go forward. So it just finishes for me to wish everybody the very best for the future in whatever business you're sort of managing today. And thank you and goodbye.